Good morning. So we have a first here on Goldfinger Capital, Mako Mining, MKO on the TSX Venture. We have uh, Akiba Leisman, the CEO of Mako Mining Corp. Somehow Akiba and I have managed to avoid each other all these years in the junior mining sector. So this is actually our first real conversation, and we're doing it on camera. So I'm pretty excited to dive into it. How you doing this morning, Akiba?
Doing excellent.
Okay, so Mako is a producer, something that we don't always talk about here on Goldfinger Capital. We do a lot of explorers, but producer. But you also acquired a project in Arizona in the last year, and it's a project that I actually know, the Moss Mine. It's actually a mine, it's not a project. But maybe it is a project too, because there's room for more expansion there at Moss. So, Akiba, I kind of want you to lay the groundwork for the company and tell us your vision.
Sure. So I would say there's two primary things that distinguishes Mako from most other companies in our market cap snack bracket. The first and foremost is that we're structured with our own in-house engineering, procurement, and construction management team. And I think there's actually a lot of senior companies that are set up in a very similar fashion to us. In fact, I would say most of them have the ability to go acquire, engineer, and build mines themselves. It's actually a very useful skill set to have amongst the senior community. The mid-tier space, I can think of a handful that are set up in a similar fashion to us. When you get down to the junior space, there actually are very few companies that are capable of going and acquiring, engineering, building, developing, expanding multiple assets across multiple jurisdictions. So I onboarded Jesse, my COO, back in 2019 when the management and board changeover of Mako and its predecessors happened. At the time, he had probably about 16 people working for his family-owned full-service EPCM firm. And essentially, they've been onboarded as our kind of go-to guys, not just for individual projects, but really to go and acquire, de-risk, engineer, build, expand assets across the Americas. The second distinguishing factor about Mako, and it's always been kind of, I think it used to be a controversy, and now I think most people, when they realize just how beneficial it was to the company, really no longer view it as such, is that we have a controlling shareholder, Wexford Capital. So I used to work for Wexford. So even though I am an engineer by background, I spent most of my career in the mining side as an investor. So I used to run their precious metals portfolio in Wexford, and then really starting in 2014 part-time, and then in 2018 full-time, managing some of their portfolio companies, of which Mako is the most advanced. So I took over as full-time management in 2019, and then having a controlling shareholder with deep pockets was essential, really, in the bear markets. I mean, the way that I always described it to our investors is that you really shouldn't expect to make money in bear markets. Bear markets are really there to make sure that you can set the pieces on your chessboard. Make sure you preserve your options, so you don't go bankrupt, don't go under, don't dilute yourself to infinity, and then just wait for the cycle to turn. And it can happen quicker than people think. It can also happen a lot longer than people think. But actually having a controlling shareholder in the background was probably the most essential component of Mako to effectively keep those options alive and grow when we were in the bear market.
Yeah, I think that's an excellent point you made, Akiba, that the bear market is when you build. It's not really when your share price is going to do a 5x or a 10x, or you're going to grow from 40,000 ounces a year to 400,000 ounces a year. That's probably not going to happen during a bear market, because financing is just not going to be, as abundant and available, and it's probably going to be very costly if you are able to get financing. But it's impressive what I've seen Mako do. I think I may have first become aware of the company sometime around 2018 or 2019. The San Albino mine, which is obviously your flagship. It's what got you the cash flow to do the expansion that you've done in the last few years. So tell us about San Albino for those who don't know about it, and how important that cash flow has been for you.
Yeah, and it's a hugely important component of the company. San Albino was scoped out to be the highest grade open pit mine on the planet, or at the time it was a development project. So prior to the creation of Mako, which was a merger of two companies, one which Wexford controlled on one end, and the other had also some elements of control, if you will. I won't go into the full history, but we merged the two companies together at the end of 2018. At that time, it was a fully permitted project, but the various management teams and the boards did not get along, and basically everybody was just like tripping over their own shoelaces to try to develop this asset. So it got its full permit for construction back in 2017, and then effectively nothing happened for 2 years. So after the merger happened, and then most importantly after the management and board change happened, we actually went about building it. So we raised two tranches of equity capital, each one approximately US $20 million in size. One in 2019 in the form of a rights offering, and then one in July 2020, which is the last time this company raised equity. There was additional $21.5 million US of debt that went onto the balance sheet to build San Albino. The last bit of that was in February of 2021, 5 months before we declared commercial production. Now, as I know people like to forget about the calendar around 2019 to 2021, this obviously bookends the pandemic and in the meat of it. So if you actually think about what we did with that money, is that we built this extremely high grade project, and then the pandemic really went global 5 months into the build. We were about 25% building it. We actually lost access to the country of Nicaragua for about 3 months, and it really required a lot of creativity on how to continue the build during that period of time. And then when things started to calm down a little bit, then we were hit by 2 major hurricanes on the back end. And even with that, we were able to deliver the mine more or less, hopefully there are no squibblers out there, but more or less on time, and then more or less on budget. And one of the things that we're most proud about is that the last time that this company has actually raised any form of capital was before the mine turned on. Usually in this industry, you see, especially junior and undercapitalized companies deliver a mine, and then that really is the excuse to actually start raising the real money, because basically everything was a fake it till you make it type approach, where you kind of dribble these capital raises, and then the real capital is there to fix the problems that were ignored in the beginning.
So, oh man, you're speaking some truth, Akiba.
Exactly. So without going into specific examples, I'm sure everybody can come up with their own.
There's so many.
Yeah. So and going back to your point about relative importance, right? So the issue with San Albino is that it's a very complicated ore body, very complicated geology. There's plenty of exploration upside. We have at this point over 220 square kilometers of ground, with double-digit gold showings across 28 kilometers of strike. The problem is that the geology is spotty, right? So it's very difficult without a lot of drilling to put together a functional, long-lived resource. And we're actually very meticulous about our technical data when it comes out to not only public disclosure, but also how we manage it from an internal process perspective. But the one of the side effects of having a complicated ore body over at San Albino is that you can never really have like a large scale mine life. So when you talk to investors about it, and you actually start modeling it on a spreadsheet, the actual value of San Albino is never all that much, especially relative to the other assets that we have in the company right now. You alluded to Moss before, as well as the Eagle Mountain Project in Guyana. So I almost like joke around with people is that now we're even though I'm not mature, we are a mature company. So a lot of people kind of look at us for bank lending programs or even equity analyst programs, which we don't have at this point. We do need to come up with a functional corporate model. And anytime that we do that, San Albino winds up being like around 12 or 13% our corporate NAV at this point with all the acquisitions that we've made. That being said, it's 95% of our cash flow at this point. When Moss fully turns on over the course of the next 4 or 5 months, it still will probably be about 70% of our cash flow until Eagle Mountain gets up and running in 2027. So it punches above its weight in terms of actual importance as opposed to modeled importance. But you're right. If it wasn't for the fact that this was a cash flow generator, so since that time that we declared commercial production in July 2021, we've repaid the entirety of the principal balance of debt, the $21.5 million. We repurchased over $7 million worth of stock. We've reinvested over $40 million worth of cash flow into exploration over at San Albino. We've increased our cash balance from effectively zero, because we were running on fumes at some point back in 2021. To the $28.6 million that it was at the end of Q2. And on top of that, we went on to an acquisition strategy where in 2024, we announced the acquisition of 2 pretty significant projects and mines within the portfolio, all coming from the cash flows that were generated by San Albino.
So at San Albino, the opportunity, and I recall that was why it was really tough to value the company back in 2019 and 2020, because you didn't have a resource that could say, hey, we have an 8-year mine life, we have a 10-year mine life, right? Which we're so accustomed to in the mining sector. And all these bank analysts want feasibility studies with, the resources in proven and probable categories and all this stuff. And so it can make it very difficult for an ore body like San Albino. But I guess that was also why the opportunity was available to you to pick this asset up and advance it when there wasn't as much competition. Is that right?
Well, sort of, right? So that all of that is true from a reality perspective. When it comes to actually 43-101 reporting, the interesting thing about the predecessor of Mako is that it did have a long-lived resource, and it did have an economic study on San Albino that showed, at least in a pilot operation, in excess of a 30-year mine life. The problem, it was all bullshit, right? So it's like I've seen worse technical studies and resources put out than what the predecessor of Mako did. But what they did do is that they really weren't controlling the model based on geology, which is fundamental to how you have to put these resources together. You basically were just stringing some gold assays together and putting this big thick ribbon around it. So at one point there was a 900,000 ounce resource over at San Albino, and the market at one point prior to our acquisition got excited about it. The problem is that the company and our predecessor believed their own BS. So they were trying to go about advancing the project and turn it into a mine without doing the appropriate technical work to do it. So when we took over, the first thing that we did in 2019 was to, in addition to raise the capital to build it, was to also put in a pretty urgent 36,000 meter infill program that was the basis for our very explicit modeling of the geology and the lithology of the project. And then when we put out our updated resource in October of 2020, we were exceedingly proud of it. I don't think we were surprised at the market reaction, but the market effectively pooped on it, right? So it's like, all right, I think a lot of investors have been trained and taught that it's much better to have a spreadsheet that shows something that you can value as a long-lived asset as opposed to good quality data. To me, as an investor, like I'd actually rather have no data than bad data. So, and I think it's like a fundamental difference in terms of how we go about the world versus what the expectations for a lot of investors in the junior space is. Now, we've never actually put a Mako stamp economic study on San Albino. We've only done the original updated resource in 2020 and then an updated resource in 2023. I could say since inception, inclusive of inferred ounces, we've positively reconciled by over 20% of that. We don't have any issues with putting out actual economic studies associated with it, even though we're not required to as a producing issuer. So, for instance, on Moss, we're just because it's effectively a mine, or at least 30% of a mine. We started mining operations a few weeks ago in a small scale basis. We're going to be putting out an updated pre-feasibility study in December. So if we have the data to support it, and that data somewhat reflects reality, then great. I have no issues doing that. But San Albino, we never actually had the ability to put an economic study that put a stamp on something that looked like what we were actually doing on the ground. So I always thought that was going to be, if anything, misleading to investors if anything got put out in that capacity.
Okay, let's talk about Moz, and then I want to go back to the company's growth potential and sort of maybe how to value shares of Mako. So the Moz mine has a bit of a history, as most mining assets do, especially in Arizona. There's always going to be some history there. So this is a mine that failed, essentially. The previous operator basically went into bankruptcy. And that was during a decent gold price environment. It wasn't a $3,000 gold price environment, but it wasn't a bad gold price environment. So tell us about Moss. I mean, how did you come to acquire it? What opportunity, do you see there? What did the previous operator do wrong or not do as well as they could have?
Yeah, so it goes back. Well, first of all, for those that don't know, even though I'm giving this interview from New York, I would consider our operating headquarters to be in Arizona. So we've had a presence in Arizona for multiple decades at this point. So certainly we were familiar with the asset. And I'll go over a little bit about our explicit history with it. If you can break down what Northern Vertex and then Elevation did, looking at it in an objective fashion, is that they wanted to go and advance an asset in the quickest amount of time possible, with the least amount of equity capital to go and do it. So if you look at that statement in an objective fashion, that's not irrational, right? So it's leave what actually wound up happening to aside for a second, is that actual plan sensible. Now the problem is that they kind of broke up the execution on that strategy in twofold. One where I have actually a lot of sympathy for, and then one which I don't. The one where I actually have a lot of sympathy for is that they intentionally knew that the United States was an extremely difficult jurisdiction to get a permit in. So when the original pilot plant got built between 2011 and 2013, they were building it exclusively on private land to avoid any federal nexus on the permitting side. And then when there was a lot of issues, actually the first time that we visited the site was during the build out of the pilot plant. We saw that there was going to be some pretty major operating issues going on at the time. And then when they tried to develop this as a more, let's say, quote unquote, commercial operation from 2017 to 2018, they intentionally sized the operation such that it avoided going through the United States NEPA process to eventually have an environmental impact statement. And basically what that meant is that any federal nexus on the permitting was very, very straightforward, and you didn't have to go through this in potentially 5-10 year permitting mess that used to be in the United States, which is really no longer there, but it used to be when they were building this. That decision caused them to be very, very restricted on a lot of the ground that they were operating in. So Elevation, from an operational perspective, never got out of that level of constriction in terms of where they were. And in fact, the most obvious example is that they literally built their 8,000 ton a day 3-stage crushing plant on top of half their resource. And it wasn't because of bad condemnation drilling. It was like you can actually see the outcrop for some of these veins going straight under the footings of the plant. They did that because they just didn't have space. So the avoidance of dealing with NEPA and specifically hardcore U.S. permitting, I get, and I'm sympathetic to a lot of companies in their situation. What they did that I unequivocally reject is that they try to build this thing by basically taking this dog's breakfast of all of these various royalty and debt financings to go and build this thing. So by the time that they actually declared CCAA with the associated U.S. Chapter 15 bankruptcy last summer, is that they were carrying over $77 million of financial debt, inclusive of close to $40 million of secured debt. There was a stream and 5 separate royalties on the property, where just on the royalty packages themselves, if at today's spot price, if this was debottlenecked and running at full force, those royalties in aggregate would be paying out close to 15.5 or 16 million US dollars a year on the back of a project that should, in its current design, be at best a 40,000 ounce a year producer. So when we were going in the bankruptcy, there was effectively like 2 things that we had a thesis around. One is getting rid of all of these financial obligations, and I think people have a tough time to envision what a company looks like post bankruptcy versus pre. Is that the way that I like to describe it is that we did not buy Elevation. We didn't even buy Moss. We bought Moss stripped of all its liabilities, and which was essential to really get this thing going. I make the and then finally on the operational side, because they just didn't have cash, and because this was not a focus, because they effectively knew that they were going to be going bankrupt for a period of about 3 years. A lot of the cash and the reinvestment and the operational control and frankly employees wanting to be there in the first place, so it was lacking at this organization. So without actually lifting too many fingers, we do think that even from an operational perspective, we can extract like at least US $20 million of operational synergies. The line that I could give, if you add up the financial obligation reductions and the operational synergies, it's probably running close to US $40 million a year when this is up to run rate. So at a 40,000 ounce a year producer, that's a $1,000 an ounce difference in cost structure. Elevation initially hired their advisors to go bankrupt when gold was trading at 2,100. So there's like a $1,500 revenue margin that went up. You add the two together, that's a $2,500 swing. And then my punchline to that joke is $2,500 swing, 40,000 ounces a year. That's $100 million. Guess what? I don't think Moss is going to be making $100 million a year in EBITDA, which kind of means that even at these gold prices, Elevation would still be losing money under its current structure, right? So it required the bankruptcy to go forward, and I think a lot of the producers of the world, there were actually 6 bids in bankruptcy, and we weren't at the highest notional amount. We were the only guys that came up with actual cash. But of the bidders that are out there, they were not producers because producers did not want to go through the effort of cleansing this thing through bankruptcy. And actually, we're still in litigation on some of the things on the royalty side, which hopefully will be resolved in the next month or so. But there was a lot of work to do that, and I think coming from our backgrounds, which is certainly a mining component to our background, there's also a distressed investing component to our background, is that we do have the ability to kind of visualize what these companies are going to look like once all those liabilities are removed.
So Moss is it's a lower grade ore body. It's a heap leach gold with some silver aspect to the ore body. It's not high grade silver, but it has some silver. But we're talking about grades like 0.35, 0.4 grams per ton gold. We're not talking about high grade gold here. And the scale, I mean, as you said, they were dealing with a small footprint and trying to cram everything into the small private patented ground that they have there. They have there's a lot of federal ground that now you have. So I'm kind of interested to hear your plan. The old Moss was set up to fail, as you said. Even at $3,500 gold, they wouldn't be making anything on the bottom line with all the encumbrances that the previous operator had on the operation. So now those are wiped clean. what's the vision you see for Moss? Is this 30 or 40,000 ounces a year, or do you see this possibly growing to be a larger operation on the federal ground at some point in the future?
Yeah, there's a difference between throughput capacity and kind of resource potential in the district, right? So the throughput capacity is a separate question. They spent $150 million building that plant, so I always get a little bit nauseous when I think about like building another one or significantly expanding. So leaving that aside, yeah, no, the one of the main reasons why we're here is because there's, as you pointed out, there's, even though the actual permitted footprint on the EA is less than 500 acres, there's over 35,000 acres of ground with geological showings that I think are very, very similar to what has already been discovered at Moss. And if you think about what this got, what was extracted from the Northern Vertex and Elevation days, plus what they have in resource left, just Moss was pushing close to an 800,000 or 900,000 ounce deposit when all was said and done. And we think that there's going to be multiples of there. The entire district effectively is sitting in the same caldera with mineralized showings of very, very similar type material, potentially even higher grade than what we have over at Moss right now. The first order of priority, and I'll give you a couple of examples about why permitting is so important over here, is that when Northern Vertex got their environmental assessment approved by the government, they needed to amend it twice because they actually ran out of space twice. And the Bureau of Land Management and the office in Kingman, Arizona has always been pro-mining. They just had their kind of like hands tied during the previous administration. So anytime that you actually ask for an amendment, it would take at least a year to get approved. And then they would only give 5-acre increments. And then you'd have to give up 5 acres as part of that EA elsewhere. So they did that twice because they ran out of space to find additional ore capacity. And it was really tough to actually find useful lands to give up. So when we took this over, the way that we were underwriting it is that, as I mentioned, that plant is an issue, right? So there's probably about 6 or 7 years of delineated resource based on the drilling that they've done that we'll incorporate as part of our pre-feasibility study. But you only had about 3.5 years to go without actually having either to do something with that plant or to find more. So that's the reason, kind of like why the price got so low at the end of the bankruptcy auction, because you really couldn't put a real mine plan around that without making some serious capital decisions at the back end of it. On top of that, because they were running out of space on the permit, there's a little like relatively high grade part of the ore body on one of the northeast sections of the pit that is not part of that EA. That is an essential part of that mine plan. That should be like fairly easy to get a permit on, so we weren't too worried about that. But it was going to be urgent. It was actually going to start coming into fold probably as early as December of this year in terms of our mine plan. So when we go to the Kingman office, we were basically coming hat in hand, using the same approach to the permitting process as what Elevation was doing, is saying, I'm ready to give up 5 acres because I got an urgent need for these 5 acres just to mine the zone. And they said, guys, you don't need to do that anymore. Is that so long as you actually have effective baseline support, archaeologically, geologically, environmentally, so long as it's contiguous to your property, so long as it's within the spirit of the EA, you can ask for whatever you want and we'll give it to you, right? So that permit package has now been submitted with the intent not to do these 5-acre swaps, but to actually expand this to about 650 acres of ground. It might not sound like a lot, but that opens up everything. Like, so once we get that, we actually have enough breathing room to be mining this thing based on what we know about for a period of about 6 or 7 years without having to do anything major. And at that point in time, now we can, once we're in cash flow, we can actually start attacking what this district is going to look like, very similar to what we've done over at San Albino, with the intent of finding more deposits and with the real intent of literally never having to make that decision to move that plant, because it's going to be a pretty big process for us to do that.
Did you get a steal here at Moss, Akiba? I mean, is this a steal?
Sure. I mean, there are reasons, right? So I don't think it was illogical that the price went so low. But if you think about, because it was a kludging mechanism on how this thing was bought intentionally, in that we parked this over at the controlling shareholder for a period of time. So it was Wexford that bought this on New Year's Eve, and then Wexford agreed to sell it back to Mako for their cost basis. And we did that for a variety of reasons. We sort of knew what the clearing price was going to be about a year ago in September. And if you look at our balance sheet at the end of Q3 over at Mako, we didn't even have enough cash to buy that, right? So we were only sitting on about $5 or $6 million of cash, and I thought that's kind of what the clearing price was going to be. So one was getting some basically like balance sheet rental, if you will, from Wexford, number one. And then number two, which is probably the more important, albeit subtle part of this, is that this was a mine that was out of control. If we didn't take immediate ownership of it, things would have failed. I don't think there's any other way to describe it.
So you're saying on the ground, the operation was not going well. There was high turnover among the employees, and maybe there was a possible, safety issue.
Sure. I was not comfortable with the safety situation when we purchased this. There was a lot of immediate things that needed to happen on making sure that there was just everything from consumables, not just from the operations, but also for safety management on site. And we just needed to take this over. So Jesse and his crew were at the mine gates 11 minutes after the judge approved this bankruptcy. If I had to do this through the Mako vehicle, it would have taken months to get the regulatory approval to acquire this. And it just would have failed if we did it that way. So the interesting quirk about that transaction, so the actual purchase price was $4.65 million, and there was about $100,000 of closing adjustments that went with that. So it was $4.75 million was the actual number. There was another, let's call it $150,000 of legal fees. And then immediately Wexford put in an emergency $1.5 million equity contribution to the company to fix some of those very urgent needs, both operational and from a safety perspective. So the actual full max drawdown was $6.4 million on acquisition. But the quirk of how this actually wound up being, this was a heap leach mine, but it was still producing gold, right? So all of the cash flows that were accruing to the company were going to be for Mako's benefit. And then when we finally acquired it 3 months later, that took the net purchase. There was over $3 million of free cash flow that actually went into it. So it effectively took the net purchase price to $3.5 million. And then on top of that, I agreed with our surety bond company to release $1.5 million of collateral as well. So the effective purchase price, if you included that, was $2 million, which we subsequently recovered through the residual leach on cash flow. Now remember, mining was shut down last September, and we didn't restart it until about 2.5-3 weeks ago at about 20 or 30% run rates. So all this time, all of that gold came in and generated cash. Now we've hired a lot of people. I mean, Elevation was running this at 129 people. We took it down to initially 29. So it was about 100 people that left. None of the senior management at the mine site or the executive stayed. Even with that, the employee base, shall we say, was not up to our levels of specification. So even post bankruptcy, we took that down to 26. And then we finally found who are the real managers, who are the real guys that can step up and do things kind of like the Mako way. And now we've started to add people. So now we're up to about 66 people. We'll be at in the high 80s by the time that this is in quote unquote commercial production in the middle of Q1 of next year. So it was a little bit of a quirk that we bought this effectively for zero, because it was at a time where we were generating cash and we didn't actually have any G&A because everything was taken down. Obviously that's not sustainable. You can't run it out just on a residual leach. And then over the course of the next few months, then you're gonna actually start to see.
What's the state of the leach pads there? I mean, I was there in 2021, so that was when things were going better. At Moss, it was sort of, I guess, in the heyday. It seemed like a pretty good operation to me at that time, and they were just expanding those pads out So they're fairly new pads, right?
Yeah, there's ways of enhancing the capacity of them now, like such that I don't think you actually do need to do anything for another like year and a half. But then eventually there'll be some additional space. That's why when we talk about like 3.5 years of underwriting, not in the move, part of there's definitely going to be some leach pad expansion that comes with it, or at least maneuvering. The one thing about it when we got there is that the quality of the leach pad was fine, right? Like it actually, normally when we get involved in these situations, especially some of the global events that have happened, everybody's a little bit worried about the geotechs around, and even from a leachability perspective, permeability from the leach pads. Everything was actually in fantastic condition. I think a lot had to do with the rock type, is that this is a very, very hard, tough rock. You don't really need to agglomerate it. No sloughing. Permeability is great. Recoveries, even though I don't really trust a lot of the incoming data that came from their mine site lab. Yeah, we get to the lab on our original diligence trip, and then they have like a mass balance that's on a table that where you step into the trailer the lab is, it shakes like this. So like even something as ridiculous as that is that you're not going to get good quality data at the back end. But if you put your thumb in the air in terms of what it is and the overall mass balance, I actually think the recoveries here are pretty close to what Elevation was reporting to the market. So that's actually the one area of the project that we didn't really have many concerns about. There's been enhancements on how this is leached and how the cyanide is applied, but the actual quality of it was fine.
Okay. I feel like we could talk for another hour, but probably just 10 more minutes for this round. So two pressing questions I want to ask you before we wrap up, Akiba. So you have one operating mine in Central America. You're building a mine in South America. You're about to ramp up and operate a mine in North America in the Southwest. How can Mako do all of that inside this one fairly small company?
Yeah, all that and more. We're set up to do that. I mean, it's kind of like when we were initially putting out our program over here. The entire reason why we have our EPCM crew, which is now grown, I would say our core operating team is about 28 people, and that's in an organization that we're probably at this point about 750 employees and contractors globally. We do have the ability to pull in more projects, and I've hinted very strongly that we're close to doing additional M&A. That being said, last year, around the time that we announced the acquisition of Moss, or at least well into the diligence of it, there was an opportunity that was in a fourth jurisdiction that I really liked financially. Like from an investor perspective, you looked at it on a spreadsheet, it looked great. The problem is that would have ripped apart the team. So I do think that there are limits to what our team can do relative to the size and scope of where we are. Buying an operating mine in a fourth jurisdiction is just not on the table today. Hopefully it will be on the table in the future. But now to take on another, I mean, our skill set is effective. Obviously, we love to buy like a cheap operating mine that's super accretive to us, and do as little work as possible. That'd be fantastic. It generally doesn't exist. Usually, the types of things that make us very interested are development stage projects that are cheap for reasons that we're comfortable changing, right? Whether it's capital or expertise or whatever. And so those are usually the types of assets that we're going to go for. And to buy a fourth asset with our current structure is doable, provided that it's not going to really start pulling away people from the other things that we're doing at this point.
Is there any thought about going to the NYSE? I mean, you're now above a 500 million market cap in Canada. Maybe you're kind of outgrowing the venture. I'm just kind of interested, in your thoughts on that.
Yeah, so we announced our intent to move to the Nasdaq. No offense to the NYSE. I think I still to this day do not know what PwC actually needed to do. There was some sort of acronym that I don't even remember. All I know, they gave me a bill for $25,000, whatever the case was. They've finished whatever that was. So I think I'm ready to submit our application. And then NASDAQ has told us that it would be like a 3 to 8 week turnaround. That being said, because I've strongly hinted that we're close to doing M&A, is that literally every advice that I've gotten, both from our internal counsel, external counsel, as well as NASDAQ, is that if you do announce something, insurance providers, if you do announce something, wait until it's closed, until it goes. So if that deal falls apart, we're ready to go submit the application. If that deal goes ahead, great, but that will likely push back the listing until later in Q1.
Okay, got it. And then final question. So you're about 500 million market cap. What does Mako need to do to be a $1 billion company?
500 million Canadian, right?
500 million Canadian, right? Yeah.
So I guess one of the things to do is just use a currency with that's weaker. No, like I think the end of the day is that one of the challenges when we were a single asset producer, especially one with a short mine life, is that if you were going to be valuing us in a traditional fashion, you would never get to really any point of the market cap, just because the mine life was so short, and then effectively the NPV, if you modeled it from a mine life perspective, would never be all that much. Which is one of the reasons why our investor base really gravitated more towards, I would say, sophisticated generalists and in the microcap space, as opposed to gold specialists. So one of the things that the acquisition strategy has done is it allowed us to have like more conventional evaluation metrics. So for instance, Eagle Mountain in Guyana, it's a 1.8 million ounce resource. They did a PEA, $300 million valuation at $1,850 gold on a subset of that, of 1.1 million ounces with that. If you redid that 1.1 million ounces today, you're looking at a number that's pushing in excess of 1.3 billion US. Likewise, Moss, which I'll acknowledge, still has a lot of question marks until this is running at full capacity, is another thing that's just going to be completely additive to our not only cash flow, but also you can actually get like a real mine life over at elevation as well to value this in a more traditional fashion. And so at some point when people, I think most people acknowledge, even our critics, that the types of acquisitions that we've taken on have been highly accretive to the company. And my view is, especially if we do a third, and people realize these aren't one-offs, then you can actually start valuing the platform for what it is. So not only do you actually have inherent ways of valuing Mako in traditional fashions, principally because of the acquisitions that we've made, but now you're actually going to start valuing it as a platform. And the way that I like to describe it, there are vicious cycles and they happen in bear markets. We were sometimes caught up in that. There are also virtuous cycles. So even though I have a bear market mind, a bear market mentality, they can just do more stuff in bull markets.
Virtuous cycle, I like that. Yeah, that kind of feels like where we're at.
Sure. It's not just us. I mean, you can see a lot of. I mean, this is really the first time that the people I think are getting rewarded for M&A. So even outside, we've seen a lot of deals even recently, which I think have been very sharp. Think about me. I'm the biggest cynic in the industry. I usually hate decisions that other management companies do. But there's actually been some really, really sharp like buy side M&A that's been done in the last few weeks.
Absolutely. So Moss ramping up over the next several months. NASDAQ for Mako in Q1 2026. So the timing of those two is pretty good. They'll kind of hit together in Q1 2026. Hopefully Moss will be at nameplate in Q1. And all systems go at Mako Mining. Thank you, Akiba.
All right, thanks, Rob. Pleasure.